think we printed a pretty good set of results this quarter. I think the key indicator for us is actually customer growth, where we have grown year on year by a further 900,000 primary customer. Our loan growth has been strong, particularly in mortgages, where customer demand has remained robust across all of our markets. And I think we see a lot of resilience in terms of our net interest income. What you see there, a bit of a dip in terms of NII, that's more to do with the kind of treasury-related volatilities than the underlying business, where the margin on lending and the margin on liabilities had held up pretty well.
Now, to that said, you can't beat the cycle. And I just spoke to a lot of the governing council last week in Washington, D.C. And the message was, look, we're setting up for meeting-by-meeting decisions, but with the potential of keeping a 50 basis point rate reduction on the table as an option, because they really don't know what they're looking at in the data at this stage. So what does that mean if we got a 25 versus a 50 basis point rate reduction from here? What does that do to net interest income?
Well, if you look at the forward curve, clearly we're going from 4% a few weeks or months ago to possibly 2% within the next 12 months. And I think we have steered as ING our interest rate management through an up cycle, maintaining good profitability. And we expect that we can maintain pretty good margins on the way down as well. So we expect to sustain the profitability number in a good shape despite quite sharp movements in terms of interest rate. Our expectations is that we can maintain our net interest margin on liabilities at around 1 to 1.1% margin through the cycle. So we're pretty confident in managing this cycle.
I want to get to loan demand, because in the second quarter you saw loan demand that was up. But it's fascinating, I think, given we haven't had that many rate cuts yet, whether we're getting to any form of a sweet spot on lending markets where consumers, businesses are more encouraged to take out loans again because those interest rate costs are coming down. Are we seeing any evidence of that yet, or what is it going to take to get us back to that sweet spot?
Well, I think we're quite optimistic about loan demand, particularly in retail banking and in particular mortgages. We see demand rising, house prices rising in a number of our major markets. And we do see lending margin holding up very well, with an opportunity to even improve as rates cycle to a different level in the next 12 months or so. So I think it looks pretty rosy on the retail banking side. The wholesale bank is a little bit more modest as we go through maybe more uncertain economic outlook.
Let me give you a chance to talk about the distributions to shareholders here. $2 billion in a share buyback, $500 million in a cash dividend. Just talk us through some of the decision making here on those payouts.
Yes, we've been on a path and a program to take our capital levels from currently 14.3% core tier 1 to around 12.5% level that we think is a targeted level that we can operate profitably and safely as a bank. And this is part of our distribution for Q3, where we have decided on $2.5 billion cash and share distribution to our shareholders, about $2 billion in share buybacks, and $500 million to be paid out in cash to our shareholders. Overall, for the year, we announced approximately 5 billion euros in terms of cash distribution. So we're operating on a good path to converge on our targeted core tier 1 numbers.